All right. So welcome to Wallstreet Jackboyz Game Plan Sunday. Today is August 11, 2019, and we're here with another great session here. We're going to recap what occurred over the past week. What do we notice coming down the pipeline, and use that information so that we can, make some money here in the market. Sergio, you with me? I see you in the chat. Anything in there, make sure you drop those in the queue. We're going to go ahead and get this thing jumping. So this past week was a pretty eventful week. Okay, for the markets, it was a lot of crazy information. For Wall Street Jackboyz, our group, our community, it was a lot of money that was made. So I'm pretty proud of our setups, our plays that we had from last week. So if you missed last Game Plan Sunday, it's out on Facebook, it's everywhere else. And the information I'm giving for free. So you guys make sure you check that out. So anyhow, the start of the week was just crazy. So we started off the week off the bat when we had Treasury Secretary Steve Mnuchin come out and talk about China's devaluing the currency. And that just sent shocks to the market, right? It's something Trump been talking about. He needed somebody to come in on that whole idea, because that's a part of his campaign. That's what's happening right now. China's devaluing the currency, and it's making it hard to compete. All right, it's making it, hard to compete. So that sent jokes to the market. If you guys are looking at my screen here, you can see that massive sell-off right there. Let's drop the arrows here. If you're looking at the screen, see we caught that sell trigger. We were already at these tops here, at these ceilings. We caught the sell trigger, and then that's when you get all the down pressure. Boom, boom. All right, boom. You get all that. So we end up dropping beneath our 100-day moving averages. And that was the start of the week. So it was a lot of volatility that was in there. We had a couple of members like the Doc. He was in there talking about buying those calls on the VIX. And it was cash out season. There was a lot of money that was made at the same time that you see the markets going down. But there's other plays that you can do to make money while the markets are going down. That's one of the beautiful things that, we offer, that's offered in the marketplace called options. And that's what we trade that allow you to be able to make money no matter what direction the markets is going. So anyhow, that's what we saw happen there. And then we caught the markets rebounded from here to here. So it made it back up to its 50 moving average. Okay. And it's stalling right now at that 50 moving average. So this is where we are today. We're up against the 50 moving average. Okay. So this is a very treacherous playground that we're headed into right now. Because we're at some key levels of resistance that's up ahead. So that means that the markets may chop. So we may, more than likely what we're expecting is the markets to chop sideways. We don't expect to see a rally. We hit these new highs here the week before. And this could be the end of the bull market as we know it. Who knows? There's a lot of information, a lot of data that's being released. We're seeing the economy weakening. And we're seeing, bonds is just going crazy. Bonds is going up. They're buying up a lot of bonds. We got a lot of negative yields around the entire world. We're talking globally. So it's not just the U.S. It's the whole entire world, basically, where they're in a mess and they need help from their central banks, which is the Feds. They need the Feds to try to come in and fake it till you make it type of deal. But they end up creating they create the mess, and then they are like the heroes or the saviors of the mess that they create, and they only make things worse over time. So anyhow, we saw that occur in the markets last week. So we started out with lots of volatility. Also, let me pull up the yields. Okay. So you guys can see this is the yield curve, and I haven't updated the Friday. I've been super busy, but the yields are pretty much in the same, position they were in on Friday. It's just about, a percentage point basically difference. But this is what we're looking at here. All right. So this is important for you to understand, because you need to know where we are in the economic cycle so that you can actually guide your investing decisions based off of this high level information. So what we're seeing here, what we're gauging is the 3 months versus the 10-year. And as you guys can see, this stuff is lopsided. This is what we call the yield curve inversion. So if you loan the government your money for 3 months, all right, that means you're going to make 2.2% versus you loaning your money for 10 years. You're only getting 1.72. That's not the way it's supposed to be. Okay, because as time extends, you have more risk. You don't know what's going to happen in the future. You don't know if the government going to be able to pay it off. You don't know if the dollar is still going to be the world currency. You don't know any of those things. But, 3 months, we gave the short term and we gave the long term for that. So 3 months, 6 months, the government's still going to be here. 10 years, nobody knows. It makes it more risk. So if you're going to loan on your money for 10 years, you're supposed to get a higher yield versus the short term rates. When that doesn't happen, when you get a lower rate than the short term, then you have a yield curve inversion. This is the number one indicator for a recession. Okay. Number one indicator for a recession that is to come. And it happens over and over and over again. So it happens so many times throughout history. We already know how this story is going to end. Okay. So it's not just being doom dusters or just trying to say, hey, it's just bad. Or I want this president. Well, it's nothing to do with that. It's just pure economics. This is what we're seeing here. Now, this is the data. To give you a little more contrast on this, let's actually take you to the spreads. So I'll show you the spreads here. And this is another key thing that happened this week. Normally, you guys see me when I'm charting the treasury yields. We're looking at two different yields. We're looking at the 3 month versus the 10-year. So, and again, this chart is available on our website. If you want to interact with it, you can actually do your own research. We got over 30 years of data. You can go back and see how this stuff works over and over again. Anyhow, so I'm going to play around with it, interact with it so you guys can see what I'm talking about. What's important here is that we normally gauge the two. We gauge the 3 month and the 10-year. So the 3 month yield versus the 10-year, that's short term versus long term. And when it doesn't, when it inverts, then that's a sign for recession to come. All right. So we got our first inversions back here. We see that. Okay. So again, the 3 month and the 10-year. So the gray and the blue. So the blue is supposed to be on top of the gray. Just like that. They're supposed to spread out like that. The wider they are, the healthier the economy is. So the wider they are apart, the healthier the economy is. You can say, hey, we're in the bull market. The economy is doing great because the yields, they tell us that. The bonds tell you what's happening in the future. Okay, the bond market is where you get this information from. It's not that I'm a psychic. This is just because I study. You can study too. So when you get the blue, the line, and the gray line, which is the 10-year long term, and the 3 month, which is the gray line, when they squeeze into each other, then you get what they call the flattening of the yield curve. So they start to flatten. Now, when they cross, the short term goes up over higher, then you have an inversion. And that is letting you know, letting investors know, letting economists know that there's a pending recession. We don't know when it's going to get here, but it's on its way. All right. And typically it comes within 2 years, so within 2 years. There are some that believe that we're already in a recession now. And as you guys seen every time in the past, by the time you really hear about it in the news, it's already blown over. So you got to watch the economic data also, especially if you're risking money in the markets. You need to understand how this stuff impacts the stock market as well. So anyway, we got an inversion here, right? And then they came back up. They kissed each other a little bit here. And then it spread even further for a longer time. And it's still inverted, okay? Still to this day inverted. Now, we came up and kissed this line here, but then it came back up and it just never went back. So prior to this, we had the Feds. They just cut interest rates. And you guys notice, you've seen it all over the news. Feds cut interest rates by a quarter-point basis. The markets are not happy about that. The markets wanted a 0.50 basis cut or higher because they don't believe that the cut that they did is going to help stimulate the economy because it's slowing down and it's getting ready to get really, really bad. So what we're looking at, what happened this week, okay, and as you see, this thing spread out even further. You see how when it's the wider it is, the worse it gets now because it's inverted. All right, so I showed you that because I want you to see what we're talking about when I threw on the 20-year. So this 20-year is another one that they gauge, okay, that, financial analysts, economists, we gauge the 20-year as well. And that was actually doing well. As you see, this whole time has been trading above short-term rates. But it inverted this week right there. Okay, so that scared the markets off again, that inversion. And what is happening is that we're starting to see more shocks in the environment. Okay, because countries, this is bigger than just America. It's everybody. Okay, and you got to understand what the feds do to try to help save the economy. They use interest rates. They cut them or they raise them. To cool the economy off that's over hot, if inflation becomes an issue, they raise it. And that to stop you spending. When it's starting to go down, when they cut rates, that means they didn't need for you to spend more money. So they're putting credit in the system. When people got more money, psychologically, they spend more money. You live in a real life matrix. Okay, so I'm just showing you guys this is what it is. All right. Anyhow, you guys that's on the Facebook side, make sure y'all share this video, get those thumbs up if you like what you're hearing. Okay. So anyhow, this is what we're looking at. Good. I see you, Topaz. So the inversion, again, another inversion unraveled this past week. That also worries the markets. So you start to see a lot of sell-off. All right. So when you get these type of things in a recession, right? Or slowing economy, stocks, again, we already hit these new highs at the end of this bull market cycle. We already know the stage of the cycle that we're in. We don't know when it's going to totally spill over, but we're already at the end of this cycle. All right. And we're seeing this week, we had gold. Let me just actually go to gold real quick. Got anybody on this side? Okay, cool. All right, cool. All right, so what we're looking at gold here, I got a lot of lines here. I don't know if you guys can see it. If you're on the Facebook side, again, you want the best, the best performance here. I do suggest that you join our chat room. The links are posted there. You can join that way. Just download the app. It's free. And you'll get inside the group where you can see the full screen, the charts and everything. You can interact better. So, yeah. All right, cool. Yeah, Facebook got a little lag. So if you want the best experience, join the chat room. I dropped these charts a little bit so you can see a little better. All right, so this past week, we had gold that hit new highs. In fact, gold hit record highs. It's like the 6-year highs for gold. Okay. In fact, what I want to do is, again, I know you guys on the Facebook side, you might not be able to see these full screens, but I want to go back. All right. Good. That's right, Mark. Mark said gold is wilding out. Yeah, gold is wilding out. Gold is showing out over here. All right, so I got a lot of different signals that's on these charts here, if you guys can bear with me. What I want to show you, this is something that was real interesting, that is something I just discovered myself. I was looking, I was like, it's just crazy, man. Gold. I'm just going back 20 years here, okay? So 20 years of gold. Let me just show you guys what's happening with gold. 20 years of gold has returned 499%. You guys see that? You guys see that? Let me know if you see that. 499. Somebody type 500 in the chat. Type 500 in the chat. Let me know you see this. 500 in the chat. Okay. There we go. Thank you. 500%. 500% on gold. You guys can see it on the Facebook side. 500% on gold in the last 20 years. All right. I just want to show you this real quick. You may get a little lag when I switch the charts, but I also want to show you the S&P 500, the stock market. Okay. Again, this is 20 years now. And the S&P 500 at 142%. Y'all see that? Y'all can see that? Type in there 142% in the chat. Let me know you can see me. 142% is what the stock market has bought back over the course of 20 years. So if you would have bought, the index, held on to it for 20 years, didn't do nothing, just went to sleep, slept through all the recessions and everything, you will be up 142%. All right, cool. Thank you, Sergio. All right. Snatch up a truckload right before it blasted. That's right. So you guys see that. Equities came up with 142%. You can round it up to 143. Either way, you see the comparison from the stock market and gold over the course for the long term. What has outperformed which one? Has gold outperformed equities? That's a big telltale. it has not only outperformed the stock market, I'm talking about by a long shot, 500%. Stock market ain't even yielded half of what gold has done over the course of 20 years. So the long term, gold wins, and gold is real money. You got to understand, we're not going to get into a lecture about what's real money, versus currency versus fiat, but basically all the growth that you're seeing in the stock market is really a lot of manipulation from the Feds, the central banks. This is what's causing your booms, your busts, and gold is a thing that just can't be manipulated. So whenever things are going bad in the market, gold is a safe haven. All right. So yeah, as we see, gold is a safe haven. You see, again, 499% over the course of 20 years. And gold was trading on these floors. I'm going to show you guys at these floors, which is the 100 moving average. And it was getting all chopping sideways. Now we're seeing gold take a blast off. Okay, this was the last high. Okay, this is the level that the markets want to chase. All right, so I got levels all the way up to 2,000 on gold. You see what I'm saying? This is something I'm just thinking of in my brain. This is what the Fibonacci is showing us here. And the markets, y'all know how the markets behave to my Fibonacci's. The Fibonacci work. Ain't no question about that. You see what I'm saying? Momentum just getting kicked off. This thing can blast all the way up. Here, we can see that again. Okay. If this downturn, this slowdown keep going. In fact, gold hit new highs this week. As you guys see this here, I'm going to take y'all back in on let's go on a daily chart here. All right, so this is gold on a daily chart. We just hit new highs this week. You guys can see, we just hit those new highs. All right. And we've been talking about gold a couple of weeks. We had a couple of people that's in our group on Facebook that actually bought some physical gold, which anybody can go and do that. When they bought some physical gold, and they already seeing their investment already yielding. You see what I'm saying? You'd have bought in 1,400, you're already at 1,500 already. All right. Now, the level that we are at right now is pretty significant. We're at the 618 retracement. This is a key level of resistance. And so we may get some pullback, just a tad bit, which normally reverts to the mean. What you see this green line there, that's the mean, right? So when you say get a pullback, that's what we're looking at. We're looking for price action to pull back to that line. Sometimes it creeps away from that line, and then you see it fall back to that line. That's what we call reversion to the mean. It reverts to that mean. So when people talk about buying the dip, that's what they talk about, buying the dip. Let it come back there. You enter for the next rally up higher. So all the ingredients for gold to continue to move further is still intact. The setup that we called in gold was our classic setup that I do teach here at Wallstreet Jackboyz. Is key to our technicals. It's this squeeze setup. All right, we call this out in gold. We saw the squeeze there. The squeeze lets us know it's going to fire. The green, it goes to red mode and it goes to green. That lets us know that it's firing. It can fire either direction. All right. So we take a look at other trending things like this tool here. Lets us know the trend in combination with the squeeze. Then I'm already in position before the move takes off. I'm already in here, right? Already here, or you get in as soon as it blasts, as soon as it breaks above that resistance, and then poof, you benefit from that blast off. Now, the reason why gold is actually blasting so high is that central banks around the world are buying gold. Why are central banks buying gold? They're buying record amounts of gold right now. It's crazy. You got to pay attention to these moves. The central banks are buying gold. Why would they be buying gold? Fears of a recession, okay? Because you can't manipulate gold. You see what I'm saying? They can manipulate dollars. They can manipulate currency. They can't manipulate gold. It's the purest form of money, and it still spins today. Over 6,000 years, gold has a track record. I just showed you 499%, 500% gold in 20 years versus the stock market at 143%. What was the best investment over the course of 20 years? Anybody would care to answer? Was it stocks or was it gold over the course of 20 years? No brainer. Gold, right? We just talking about sleep money. You put it in and you don't even bother it, all right? So anyhow, that's what we're looking at in the markets. We're seeing, all those things take place. The trade wars with China is a major situation, and it's something that I just really don't know, how this is actually going to end. But this is what I can tell you is that something has to be done about it. And I didn't produce any data here for you guys to take a look at. Let me actually just clear this real quick. But basically, with the trade wars of China, Trump slapping on another 10% coming September 1st. If you guys don't already know, we talked about this in the past Game Plan Sundays. He's already had, the other tariffs, but that hasn't hit consumers, right? But this new set of tariffs is going to hit the consumer markets, the stuff that consumers normally buy. The other stuff was raw goods, right? So that was corporations. They got to deal with that. Now it's going to actually come to consumers because now your consumer stuff are going to be taxed, right? And so we had shocks in the markets from that the previous week before. And then you get this week, you had the currency manipulation right afterwards. This is a mess. This is going to be a mess, and it's not going away anytime soon. One of the issues is this. You have a world power, which is the U.S. You have the second world power, which is China. And when anytime you have two competing forces, you're going to get wars. It's going to be some kind of war. And I don't believe it's going to be like a military war. I believe that the war we're seeing right now is what we're seeing right now. Trade wars, currency wars. This is a whole different kind of war that we're looking at. And so, but it's still war nonetheless. Okay. And what's happening, if I could show you guys the data, I've done a lot of research on this, but when you take a look over the course of history, I'm talking about, we got data way back in, it's over 100 years probably, right? And when you go back in the data, you can see how world powers come into play. Like this story that we're seeing right now, it's not the first time. My mother used to always say, there's nothing new under the sun. So what we're seeing right now is nothing new. Economists, everybody can tell you, we've seen these throughout history, time over time. Same situation like Trump. You have a protectionist that come into power. The outcome of the whole story is less like you already seen this story over and over again, right? That's reality. So if you're looking at the charts, if anybody know anything about the China's 2025 campaign, where China they're already on projection. They're on track to be the world superpower by 2025. That means that they are on, if you're looking at the data, the U.S. is up here. China's coming up like this. If you're looking at the data, China's coming up like this and the U.S. is going like this. And so the projection is showing China is going to take over, and they're doing everything in their power to prevent that from happening. So that's why you got a situation like 5G is going to change the world. And they are, last year we saw VP Mike Pence and all of them, threatening European countries, telling them, hey, you can't do business with Huawei, which is, like the biggest company over in China, right? And they're the technology, they make a lot of money, but not just that, they make a lot of the parts and pieces and stuff like that for companies over here in the US. So a lot of businesses are in bed with these Chinese companies, and they got to get out of it real quick because they're getting hurt. They get smacked up with the tariffs that Trump is them putting on. And then they also got sanctions on them. And China, they want concessions for their company. And this is going to be a mess. This is going to be for years. It's not going to happen no time soon. And there was a trade they supposed to came over, to end the trade, had a trade truce, I guess, earlier this year. And then they came to the final thing, and then I guess China just reneged on it. And so people don't understand how China does their negotiations. But basically what they're looking for is China said, well, we're not going to make a deal right now. So it don't matter what's happening. They're going to prolong it because what they're waiting for is 2020 election to see if there's going to be a Democrat that's going to win the presidential nomination. And so if they get a Democrat in there, the Democrat is just going to put everything back in place. They're going to run off Obama's platform, which is going to allow, again, it's going the same old thing is going to help those, it's kind of hard to describe it. It's kind of like a gift and a curse, right? You say in one way, doing business with China, what's the benefit? Consumers, you can buy cheap goods On the downside is that those companies, they won't actually do business in America anymore because your workers cost too much money. Instead, they take those jobs and send them over to China because you can't compete with the low wages that they have in China. In China, they work, man. I mean, these people work. You seen Jack Ma from Alibaba? He talking about people working freaking 80-hour weeks. You know, like, yo, that's the way it should be. That's their train of thought. And they're making peanuts. You're not going to get that out in America, right? So, you know, companies like, hey, man, why are we going to pay these kids $15, $20 an hour? They already complaining. $15, $20, go to China, pay them $1, $2 an hour, and have them out there like a workhorse, you know, killing it. So that's what happens is it's a gift and a curse. You get to buy cheap goods. You get to buy your phones and stuff like that for whatever price you got. But on the other side, you end up taking jobs away from people. So then, you know, your GDP or your people become less productive because they don't have jobs available. The jobs are getting sent out. And these things is what caused President Trump to come into, you know, to become the president, because he talked about those things. A lot of people's feeling the jobs is getting taken away and everything. And so, you know, that's what you end up, having. And this happens time over time over time. And so anyhow, the efforts that we're seeing is going to be, as we're already seeing, you know, U.S. got to try to slow down China from them trying to take over. Will it work? I don't know. You know what I'm saying? They're trying everything in their power, but this is where we get all this volatility, and there's casualties along the way. So you have companies that have huge exposures over when China, meaning that they get their goods produced over at China. Those are the casualties. So if you're looking for shorts, you know, trades the short, find companies that have huge exposure in China, you know, their whole operations. Now we are seeing companies, they're actually changing, switching the game up. They're actually taking their jobs, well, at least on paper, they're saying that they're taking these companies and moving them out of China, moving them to like Vietnam, right? So they can get cheaper labor, even cheaper than China. So their way around getting around Trump's tariffs is to just move out of China, go to other Southern Asian countries to get that cheap labor even cheaper, because China's actually their wages going up a little bit actually. And China's economy is actually, their people is actually doing a whole lot better than back in the day. So anyhow, that's just give you guys macro talk. Don't want to talk your head off about that, but it's important that you understand the environment that we are in today. We're going to see lots of volatility, still more volatility. And we're seeing a lot of central bank interfering with the natural cycle of the economy. So you're seeing the manipulation. So when you hear me talking about treachery, that's the stuff I'm talking about. I'm talking about treachery, meaning that, you got your feds, your federal banks, your central banks, stuff that they're doing to try to keep the bubble going. The bubble cannot stay forever. They normally only last 5 to 7 years before the next recession. We're in our 11th year. This is unsustainable. You can't keep on printing money and cutting interest rates, putting more credit, because you're going to over leverage the people, and the people will not be able to pay off their debts. And then the cycle unfolds. And that's where we are right now. People are stretched. Their wages are not moving. We've already went over the economic data for that. We're getting new reports every freaking week. We're seeing more store closings than ever. More stores are closing than they're opening. So there's still money that's to be made here in the markets, and that's what we want to take a look at here real quick. But from what I'm seeing, when the central banks are buying gold, okay? When the central banks are buying gold, I want to act with a sense of caution, even though I think that we still may have some upside potential in the markets. But I got to be conservative right now, because it's a lot of treachery going on right now. All right. And so when I take a look at things like, gold is a little extended in here. Do I want to buy gold at these new highs? No, I don't want to buy gold at these new highs. I would like to see, this level here. I don't want to buy gold at these new highs. I want to see gold come down to the mean, revert to the mean. All right. When gold comes to the mean, then we can re-up. But right now, it's too high for me. All right. But there are other flights to safety, like utilities. All right. So utilities is another flight to safety. There was money to be made off of utilities last week. We had a play from Game Plan Sunday on NEE. That's under this sector here. This is the sector. Okay, you can play the sector itself to the long side. As the markets go down, this normally goes up. All right. Now, what we're seeing here, the setup that we got here on utilities, is that we have our trend participating. All right, so this is when we're talking about participating. What we want to see is the stars come in alignment before we make our decision. That's all it is. So we have an indicator that says the trend is going up. All right, we've seen a shift in momentum go from down to up, and it's also in a squeeze. That squeeze lets us know that it's going to have to fire, and it's going to have to fire in one direction, up or down. Because the momentum is shifting up, the trend is going up, we're projecting that that's all going to move up. All right, we went into those oversold territories. Now, again, momentum moving up. All right, this was a buy trigger here. That's why we took a look at it last week. It went up, but the squeeze never fired off, right? Still take profits, okay? But the move is still in play. So if you missed the money that was to be made last week, there's still more opportunity here this week. Plus, we have a buy trigger here. That little blue arrow says, hey, buy me right now. All right, because we cleared the 618. We cleared the 618. That was a level of resistance. Now we're at another key level of resistance. We're here at this 161.8. How do we know it's a key level of resistance? Whether you're not a user of Fibonacci or not, you can actually just look at here. Every time it hit, boom, it gets rejected. Boom, it gets rejected. Boom, it gets rejected. Boom, it gets rejected. It will not clear. Boom, it gets rejected. Boom, it gets rejected. Oh, I skipped that one. Boom, it gets rejected. Boom, it gets rejected. Boom, it gets rejected. All right. So because we see it behaves at these levels are not in the stock market. This is a part of my training that I give you. If you are a subscriber, you already know how to use the Fibonacci. And if you guys are in the group, you'll see me using this every day. And if you need some help with some charts, you just let me know and I'll post them when I got some time. Or your peers can help you in the group. So make sure you guys join if you're not in it. So because we see that overhead resistance, we know that's a key level to watch, pay attention to. We just hit that level Friday. Boom. What we want to see, again, we got a buy trigger that says get in. So that's let me know to get my money together to get in here. But I need to see it clear this resistance level. So prices need to clear this resistance level for this thing to go up. There's a lot of arrows there. But key thing to remember is this key level of resistance. We have a buy trigger that says get in here. Trend is up. Momentum is up. Momentum is up. Squeeze on deck. And that squeeze would normally give it enough power to push through this level of resistance. We didn't have a squeeze. We had BS squeezes. Squeezes, normally you have them in consecutive dots. These are just one dots. We didn't have power to push through. Now we got power underlying. And again, you can't see the squeeze unless you got my setups, right? This is the setup that we use. All right, so we have a squeeze that gives us power to push through these levels. All right, so that's what I'm actually anticipating. That's what I'm looking into this week in utilities. I'm looking to play a little conservative because, again, we got lots of treachery. I'm expecting the markets to be volatile. I'm expecting the markets to be choppy. We just looked at the S&P 500 earlier, and it's no clear setups, and so it makes it a little harder to project. But yeah, makes it a little harder to project in those situations. But we have to make executive decisions. Okay, so you're not going to be right 100% of the time, but when you're risking capital, you want to make sure that you have the best tools to help you to make decisions. Let's just highlight from last week. Yeah, this was a really, really nice setup. Again, last week was a great week for Wallstreet Jackboyz squad. There was plenty of money to be made from the setups from our last game plan session. We had the same scenario from last week. We had our trend set up on Mickey D's. We had a squeeze in there. The squeeze is still intact, okay? Still, it hasn't even fired off yet. We got the shift in momentum to go up this way. We had a buy trigger here, plus another buy trigger here, okay? And all you just needed to see this thing do was to clear this level of resistance, which is the 618, which it did. And it's still pounding through. Right now, it's at the 127 extension. It's got more upside potential, all right? I'm looking at 225, around this level of 225, because the squeeze still hasn't fired off yet. This still has to fire off. So there's still upside potential there. All right. With that being said, I'll take some things from you guys, anything that y'all want to look at, and then we'll bring the session to a close. So if you guys got any charts you want to take a look at, type the stock ticker in the chart. And, we'll look at those things as well. All the major indices are pretty much looking the same. However, the Russell is going to be something I'm definitely going to be watching here, because normally it leads. Okay, normally whatever it makes this move, the other indices follow this one here. And it's in a very tough situation because you see this is the mean here. This is the mean that's trending down. And even though it blew through the 200, it made it back up to the mean. And now it's falling back underneath. So I'll be looking to see if this thing moves further down. This thing moves further down, then I'll be actually taking a look at some short plays right here in the Russell. I'll be looking to short those Russells. All right. That's what I'll be looking at first. And again, gold may push even higher, but I would like to see gold take a pullback before the next leg up. Bonds, again, the theme is still the same. I just showed you guys the yields. Bonds are moving crazy. Topaz, what earnings are coming up? I haven't even ran the list. You got major earnings coming up, Topaz? Anything you want to talk about? Let me just show you guys the bonds. All right, so this is bonds right here. All right, bonds at new highs also. Same thing we just saw with gold. Bonds is a flight to safety. Okay. And it hit that high and it's taking a breather. It's coming back down to the mean, as you guys can see that. So I wouldn't be surprised if it stabilizes here. But I don't see anything upwards. I see it just going sideways for right now. So a little more sideways until it builds up its next leg up, right? Which again, this would, bonds keep on, the price keep going up. Remember, price on bonds go up, the yields go down. So we've seen a yield curve, inversion. All right. When you're looking at the yield curve, and I showed you guys before, right? The 1 month, 3 months, right? 6 months. Then you got the freaking, let's just take it up to the 10 years, 20 years, 30 years. All right. Supposed to look like this. This is a sign of a healthy economy, right? And right now, that's not the way our yield curve looks. All right. It looks like this. All right. And as price goes up, yields go down. And that's what we're seeing. Prices going up because they're buying all the U.S. bonds, because we still got positive yields on our bonds versus around the world they have negative. That means you ain't making no money. You actually paying them money to lend them money. So why would you do that? So you're seeing investors buying up the bonds here in the U.S. As they buy them up more, we're seeing the yield curve get pushed down even further. And eventually you'll be in a recession. And you see those things come up. Okay. That's the way the inversion looks. And then the Feds, they try to push those rates down even further to straighten up that yield curve. They drop them down to zero. But it's going to be a major policy failure that's coming. This is treacherous, what we're seeing right now. But again, that's because of the Feds. But hey, that's what it is. And then you also got, reaction in the market, shocks in the market that just brings it on faster. This is what Trump wants, because, again, Trump wants the yields to get pushed down further. Not just Trump, but Wall Street. You got to remember, Wall Street rallied as the Feds cut rates, but they only give them a 0.25% cut, right? They only give them a quarter. They need more, right? Because across the world, central banks are cutting rates. And when they cut rates, that makes money cheap, so that people borrow more money, so that people can go and start businesses and all kind of other things they want to do with that debt to try to grow that economy. That's just the way it works. But it's negative. It's terrible. So anyhow, you know how this story ends, as I showed you time and time in the past. What else we got? Nvidia and Walmart for earnings. Thank you, Topaz, for the assist there. Do not play earnings unless you know what you are doing, or you will lose all of your money. You will blow your accounts. Again, this is starting to go into a downtrend here on Walmart. This is something I'll definitely watch because although a lot of people spend money with Amazon, Walmart is still, good, especially with low income families or people that's tight on budgets. They spend money at Walmart, same way they spend money at McDonald's. Because they normally get this stuff good for cheap. But the problem is they're getting the stuff from China, and Trump is making them. He's making them pay. It's like, hey, you got to bring this stuff back to America, or you're gonna pay. And they don't pay. They pass these costs on to consumers because, again, they got shareholders that they got to appease. They got to make sure they grow profit, cut expenses. Grow profits, cut expenses. Anytime there's a tariff, pass that shit on to the customer, so your prices go up. So that's why you hear people say a tariff, that's a tax on American people, because you got to turn around and buy those goods. So it's the corporations they're not gonna absorb those blows. They're just gonna pass it on. Then you have an inflation issue because your cost of goods that you normally buy, your toilet paper, your tissues, and things that you normally buy, they're costing you more money. Versus a year ago, it didn't cost you that much money, and so your money is getting thinner. Your dollar is not worth the same, so it's eating a hole through it. But the feds, they don't look at stuff like that because they say food and energy, this stuff they exclude from what they're looking at. And so you get the CPI numbers talking about inflation. They don't include food and energy. Those are the two things that you need to survive. You would think that they would actually include that. Well, it's like, why would you not include the stuff that I need to survive? I don't need other shit, but I need food and energy. And you don't include that in numbers to check to see if inflation is a problem. And so by the time inflation hit what they're looking at, it's already too late. I mean, we'll probably be in a full-blown recession. But anyway, earnings, new traders, you don't need to play these. You need to sit these out because they normally have binary effect, strong move up or strong move down, and you just don't know what's going to cause it. You know what I'm saying? So stay away from those right now till you get some experience. All right. One last thing I guess I'll take a look at is the VIX here real quick, and then we'll go ahead and bring this thing to a close. All right, we have Fibonacci levels here on the VIX. The VIX is the fear indicator. Again, this is fear throughout the markets. You can make money off of people's fear. Yeah, you didn't know that? Yeah, the VIX. We had, a couple of members that were actually playing the VIX this week. Made some money off the VIX. The VIX was the lick. If you didn't see this, look, this is what we see. We was already tracking this. So you got to be in the moves before they happen. These levels is not there. I charted these levels. We already saw this happening. These lows, I was not expecting the VIX to get no lower than this. So when the VIX hit these lows again, we knew to be looking for some long side. We had our handy dandy squeeze there, all right? And then we had a buy trigger right here. That blue arrow was the buy trigger. It says get in right here. Boom. When the squeeze fired off, you see what happened. Bingo. All right? Then you went from $13 and some change all the way up to $24. That was your time to rally up, take profits, all right? Because you got to take profits often. When you got those moves like that, you got to get up out of there and get your bag. Don't stay here and hold this stuff for a lifetime. This is not how we play. We making money right now this week. Get you some sneaker money, buy you some, pay some bills money type stuff. Yes, Topaz, just like you said, that's that double top. That double top. It's another classic setup. And again, we have resources for our members to help you guys stay on track. Beyond the courses, you get things like the pattern book. In fact, if you guys haven't subscribed to the list, make sure you subscribe to the list and you get this book for free. Just like Topaz is telling you about, you get all the setups in the book. This is a nice visual guide that helps you with your trading so that you can learn how to eye these things. This is the move that she's talking about, that double top right there. That double bottom. That's a bullish move. But yeah, so you get, all these resources over here and options. You got the Greeks and all of that. These are all books that's pretty good. And then you get the trading plan. You got to know what you're doing. So we have a trading plan so you know how to do these things. Anyhow, with that being said, man, I appreciate everybody for showing up. And my son Junior was over here. Hopefully he learned some things. I'm about to go pop quiz him. He better get every question right. If he don't, he's going to get punched in the chest because he's old enough to get punched in the chest, maybe even in the throat, okay? but I promise I won't hurt him. All right. Right. Yeah, I had to get him off of Fortnite. Okay, so if you got kids that's out there on Fortnite, tell them they can add Junior because he's he's a Fortnite sweaty, as you call him, playing Fortnite. I think what's your gamer tag? Shameless plug right here, right now.
It is Barry.
Barry.
IL.
Barry L. So Barry L. That's his name on Fortnite. Anyhow, you guys have a blessed weekend. We'll catch you next week. Peace.